everybody. I wanted to welcome you all to this quick podcast video. I'm here with Mark Bianchi, and we are going to be talking about investments with charitable purpose. Part of the reason I've done this podcast series is to dig into a lot of the questions on people are excited to kind of help learn some of these tax investment strategies, but the question typically comes up as what does that look like? What do you do? So I wanted to take this particular topic, investments with a charitable purpose, and kind of pull it all the way through so people could have a good idea overview-wise how this looks. So I want to introduce Mark. Mark's been doing this, doing these strategies himself personally for the last decade plus, and I think with clients for the last 7-8 years. So obviously not a newbie to this, but I wanted to throw this question out, and I want to make it very clear. This podcast is meant to be kind of a general overview and really hit a lot of the questions that people have that we hear. Is this new? Why doesn't my CPA know about it? Is this IRS tax compliant? So we're going to go through all of that. And I actually want to hit this right off the bat too, because I think this is super important. On Mark's staff, a CPA and a tax attorney. So as we go through a lot of these things, and he says, these are the things that we do, that we includes a CPA and is it one, maybe two tax attorneys. So there are people with significant, kind of chops on his team as well. So know that royal we is not, me, myself, and I. Right. There are real people behind that with some certifications. So that said, I wanted to start off with the main question we get: is this new?
It's the one we get all the time, right? So no, it's not new. It's been around for decades. The super ultra wealthy have been doing this for decades. I think one of the discussions you and I had early on was the 2012 presidential debate between Romney and Obama. So we're going back, 11 plus years, 12 plus years on that, where Romney basically said that his effective tax rate was 14%. So the wealthy have been doing this for a long time, and the wealthy are individuals making, $50 to $100 million plus, significant wealth that are familiar with these strategies. Their accountants or tax advisors are all familiar with it.
Right.
Our goal over the last 7-8 years was to bring these opportunities to our client base who are wealthy. They have good income, but something that maybe their CPA or their tax advisors, financial advisors were not fully aware of.
Right.
So that's why we focus on this.
All right. So this idea, this giving, tax mitigation strategies, the philanthropy attached to it, not new. How many people have you worked with that have done, these types of strategies?
My current client base is probably, on a yearly basis, 500 clients who are doing it. Over my course of time, I probably touched on, thousands of clients who have done it. Mm-hmm. Some people have extraordinary events and, they don't have it the year after. And some people have been repeat. But besides the client base, the most important side is, which we always stress on with our clients when we talk to them, is let's get the CPAs and the tax attorneys or their advisors on board with this strategy. And so if we're actively having 500 clients, that means we have well over 400 some odd CPAs who have signed off on this, and not just last year, but for 7-8 years that I've been doing this.
Right. Okay. So, I mean, we've definitely got it out there. You're doing it. So let's talk about what the it is, this charity, investing with this charitable purpose. What is it? How does it work?
Well, the way it works is that we have identified a company that has an incredible product that they are bringing to the market. They need to raise some additional capital to get that product to the market. They're in their final, let's just say, FDA approval stage. And some of the best ways of marketing something is through charitable giving, right? So we're able to help them raise capital with inventory that they have, and we're only really acquiring a certain percentage of that inventory that at a wholesale price that the investors who come into these opportunities have the means to sell the asset if they want to at a incredible markup. They can hold it to see if future valuation is going to change. or they are able to donate the asset to a charity, in which we help with all the paperwork and all that, and get a significant charitable deduction based on the fair market value of the asset. So it really is a benefit. Like I said, we've been doing this for years. We assist all the way through with the clients, and we do leave it in the hands of the clients to decide on what they want to do with it.
Right. So take me through the compliance on the IRS side. So when people say, hey, people are doing it, whatever, how compliant is this? Are we flying under the radar? Like what are the kind of the I's dotted, T's crossed, if you will, of this product?
Anytime you donate an asset that is going to be greater than $500, the IRS requires certain paperwork to be done, right? So let's just say you have an asset that is greater than $500. So going to the charity, you need the letter from the charity of acceptance of that item. They physically have accepted that item. They will then sign off on an IRS form called an 8283, which they have to provide to the taxpayer. And the third item, which the IRS requires you to do, is to have a third party, unrelated appraisal done on the asset. And what they'll do is they'll look at the asset that's being donated, and then they'll look at all the competing products or similar products that go up against that to be able to substantiate the value that you're donating. So those are very, very important to be able to take the deduction legally, and you will be submitting some of that information along with your tax return.
Right. So the client would then ultimately get what in their hand, like a K-1, or
they'll get a K-1. They'll get the 8283 form. They'll get the letter from the charity acknowledging the donation, and they'll have a third-party appraisal letter as well.
Wow.
Those are all important. What they all do is they substantiate and validate the donation.
Right. So, I mean, I'm hearing that there's a lot of work that goes on to really make sure that this is all valid, this is all above board, that, again, all the I's are dotted, T's are crossed. And again, when you say the we, it's not just you going out there. Like, there's a lot of work that goes on behind the scenes, both from a tax standpoint, an investment standpoint. Take me through. I like it when you explained the four wins in this.
The four wins. So the company that this product that we did last year, they were looking to raise capital to get to their final stage of FDA approval. Mm-hmm. They were very close years ago, and then unfortunately COVID hit and it delayed certain things. And they had to go through a few more clinical studies to prove the legitimacy of the product. They wanted the cultured period to come down. And one thing that they want to be able to do is to have the capital to help get to that finish line. But they also didn't want to dilute their shareholders who have been with them in the early stages. Right. So it was a win for them in doing this. The 501c3s that will be receiving this product, the hospitals, the burn centers, that's a huge win for them, because now they're not paying for the product to get it into their hands to be able to do the procedure. The most important one is really the patient, right? So what this product basically does is it takes a skin graft off of a burn victim and it puts it into a bovine collagen matrix that cultures that for over 30 days, and that skin grows to 400 times the amount. So it is a permanent solution to the patient and their families for them to be able to go home early. So those are the first three wins. And the fourth win is for, as I always say, people like you and I who have made investments in this, of being truly philanthropic, of helping these burn victims, which is the number one concern here. And in doing so, getting a charitable deduction following the IRS guidelines. And that's why those documentations that I mentioned are very important when the process happens.
Right. And I want to make it, just a note that, we have the ability to do this with this particular company now, but there are other opportunities that we're looking for. If someone, watches this, we're taping this right now in, April 2023. If you're watching this in 2024, 2025, it's going to be, the opportunity is going to be out there, but it may be with a different company. But the charitable backing, those same four wins are going to be available with the company, the patient, the nonprofit, the investor, like they're all still going to be there. And I just think it's important for people to know a lot goes into really kind of identifying these companies and then making sure those 4 wins are still there.
Absolutely. And vetting them out, right? So you want to vet out to make sure that there's a viable product, that there is a need for the product, that is not just something that somebody's created and trying to get it out there. There is a need. This product in particular is a revolutionary product. Nothing else exists like it. So, and we are constantly looking at other opportunities that can truly be philanthropic and a benefit to a patient. That's our number one thing is the patient. And the patient doesn't have to just be somebody who is in a hospital. It can be somebody with a hearing impaired that, we're looking at a product that may help them to be able to navigate through the streets by having a different product that is implemented in certain towns to help the hearing impaired. So, or the blind or whatever it may be through these products. So we're constantly, it's not something that we just pick up the phone and say, hey, we want to do this. It's vetted out for years. It's not just a simple thing.
Right. Let's talk a little bit about the benefit to the investor.
Okay.
Because I know we haven't really hit on where this kind of fits. What's the maximum kind of benefit to someone in a particular year? And I kind of know the answer, so I'm just going to lead with the question a little bit. Like based on someone's AGI, which is their adjusted gross income, what's the maximum benefit if it's charitably contributed, which it was last year? What's the maximum benefit that someone could get? And then follow that up with who's really then the best candidate to look to invest in something like this?
So the benefit is that they have the ability of offsetting up to 50% of their adjusted gross income. So let's just use $1 million earner, right? And we'll use a 40% tax. If we're able to help donate something to a charitable cause and be able to get the fair market value of that asset, and they hypothetically invested X amount of dollars to get the 50%, that 50% will have a offset of approximately $200,000 of tax savings. So whatever their investment amount was and the fair market value of it would be the differential of what they're saving. So and then some states allow the deduction as well, like the Californias, the New York states, and then we have many states that don't allow it. They don't have a state tax or they don't follow the federal guidelines on it. And we assist with all those to show a client what the net benefit is. But it's a substantial benefit. You can't go over 50% of your adjusted gross income. In the event that the fair market value came back at a higher amount than you needed, you can then just use the difference for the following years in doing it. And then the second question was, help me again there. What was the?
Well, really, who's the ideal candidate to even look at something like this?
Again, it depends on the client's effective tax rate, depends on if the state deduction is allowable as well. And that changes the dynamics of the investment. So somebody potentially in California making $300,000 with a state benefit, they can see the benefit to say, hey, the benefit is you're being philanthropic and donating something, right? That's the number one thing. But there would be a tax savings with that. A $300,000 earner potentially in Nashville will have that benefit, but it won't be as great. What I always tell clients that when you're really looking to calculate what that is, the effective tax rate of 37% is that we keep hearing in our head and everybody talks about really doesn't kick in until you're making over $650,000 as a married couple. Maybe it's a different number being single. But, so if somebody's making $1.5 million and they had the ability to offset up to 50% of that, that is going to be truly a 37% benefit just on the state level, the federal level, not including the state level. So those numbers change significantly in doing that. So a $1.5 million earner who potentially invests X amount of dollars can have a $750,000 deduction that will save them probably $325,000 in taxes.
It's real money.
It's real money, and we always talk about that, once you write that check, to the federal government, which legally you have to write those checks, which we always talk about, is that you're not going to get a return on your investment. The money is going to be gone. These programs are in place for taxpayers to take advantage of them. They're just not aware that they can do this, right? And what happens when you have additional liquidity? You're fueling the economy, right? You're going out there and you're buying more things, or you're helping your savings account grow. Right. So there's pluses, and the IRS, Congress, and everybody is aware of additional liquidity allows you to spend more money to fuel the economy.
Right. I'm going to ask you the question that that I think is probably up there with number one. If is this new, which is, why hasn't my CPA told me about this, or why doesn't my CPA know about this?
Yeah, there's a couple of things, of course, right? And I'm always a defender of CPAs on this stuff, because I wouldn't want to have to worry about 8,000 different tax codes and tax codes changing and waiting for the IRS to put out some information on them. They're not aware of it because you got to deal with that, right? Mm-hmm. And in some cases, I always use the analogy of a CPA as a general practitioner, like a doctor. Mm-hmm. They're going to analyze everything. They're going to take the information that you give them, and they're going to be able to put it into a system. If it's drawing blood as a doctor or putting it into the system as a CPA, they're going to come up with what your taxes are. It's the specialists that specialize in this, and we have this in every field, right? There's somebody who specializes in something that they're going to educate the CPA. They're going to educate the taxpayer. And one thing that we always talk about is the taxpayer is going to love this from the moment they hear it. Very few are not going to love it. We need the CPA or their tax attorney or their advisors to be fully on board with this. We want them to be comfortable, and that's why we open up the phone lines, to be able to talk to them and walk them through this, right, and educate them, right? We're educators, right? We're here to educate our clients to see how they can take advantage of something that's been around for many, many years. And that's why some CPAs are not aware of it, but there are many CPAs who are. And so it's a benefit. It's not just CPAs who are not aware of it. Tax attorneys are not aware of it. Some financial advisors are not aware of it. And that's why we do these podcasts. That's why we do events to educate, not to sell. It's about education to see what they can do and follow the guidelines. The tagline is, paying taxes is a legal duty. Paying too much is a personal choice. If you do not know about these programs that exist that are put there, IRS approved and everything else, you're going to be paying a maximum amount of dollars in taxes.
Right. I think it's also crucial for people to understand you can do this wrong, and you want to do it the right way. You've got the right staff to do it. You pick the right companies to do it. We do the right amount of kind of vetting and due diligence. So a large part of it's education, and then also recognizing that this opportunity is born out of, a group of professionals that really have spent a lot of time vetting these things out. So with that, I do want to invite anybody who's listening or watching to call. Or contact me. My name is Erik Flegal. It's Family Fortune Financial. I can get you in touch with Mark. This is one of many things that we do, but I wanted to take the time. I mean, Mark's a real person, right? It's sometimes we do these podcasts and it's like two screens and you're like, where is this person? Does he really exist? He's really here. We really do know each other. We really have done business. I personally have done some of these strategies myself, so I can speak to it. I've received the forms. But I think it's important for people to understand that this is kind of first brushstroke. We've been doing this. We've been talking for 15 minutes. I expect there to be additional questions. And candidly, most of them we've heard before and we've talked through. So I would encourage people to call so that we can answer those questions. And definitely do not do anything like this until you feel comfortable. Ask those questions. I think it's really important for people to have a good understanding of what's going on. And then once they do, I think it's something that people typically come and repeat over time, because it is an effective strategy that has been at that $100 plus $1 million level that we're bringing down to, I think, that accredited qualified purchaser level, that $1 to $5 million level plus. And we want people to take advantage of it. So with that said, feel free to reach out. And
I have one question, which I think, we touched on before, is reach out this tax year. Reach out during this calendar year to get that benefit. You cannot get the benefit when you see your CPA in March of 2024. So it's important to be informed and know about it, but it has to happen in the current tax year to take advantage of that.
Yeah. So when I think about tax planning too, and I'll throw this out the last piece, our busy season isn't a CPA's busy season. I think for the specialists, our busy season is like winter. I'd say like October, November, December, because that's when people have a general idea of what's going to happen this year. They've got 9 months behind them and they're coming into the home stretch thinking, all right, here's what it's going to look like. We do the majority of our strategy, I think, and implementation at the end of the year. Once we get into the next calendar year, it's calendaring for the next year. There are strategies you can do in the next year, but this particular one is only able to be used in that calendar year. So thank you for bringing that up. I forgot to bring that up in our previous question. So that said, I look forward to talking to everybody. Talk to you soon.
The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.